Hello guys, as promised, I'm gonna try to show you guys what I have learned over the past 2 or so months and what I'm trying to do with the knowledge I have as of now. Keep in mind I'm still new to this. I'm trying to learn almost every day. There's so many gaps even in my knowledge, even in what I know today. But I'm trying to put it in practice and see uh, if I can get any result out of it. So first, I will try to explain you guys what options are, what kind of options I'm using to trade, and uh, after that, I will show you guys on my laptop basically what I'm using as triggers as I'm day trading them, or if I'm doing weekly spreads, how I'm going about and doing it. So if you think about an option, so I'm going to try to write on my tab. It's hard to write on a laptop. So it basically, one option holds one contract and it gives you the, at the time of expiration or before expiration, at least for American options, it gives you the option to exercise your contract. So let's say you were bullish about the company, so you buy an option. I'm just giving a company X here. You bought an option for a company with an exercise price of 15 bucks. Today the company is at $10. And at expiry, let's say the company actually finishes at 17. And what that does is basically, so at the day of expiry, let's say you bought a contract with an expiry of 1 week. At the day of the expiry, you take the stock price at the day, which is $17, minus your strike price and minus your premium you paid for. I'm gonna come to this. And this is your profit. So let's assume premium is zero for now. So you have $2 per contract, which an option contract holds 100 shares. So from this transaction, you actually make $200 profit minus the premium, which for now we assume it's zero, but it's never zero. There's a reason people are buying or selling options, right? So let me get into a few of the terminology. So we talked about the premium, expiry. We have the premium, expiry, exercise price. So these are the things you gotta learn right away if you want to do anything with options. So exercise price is basically the price target you have for the company, where if it doesn't pass that exercise price, where you're bullish or bearish, you don't get the you don't have basically you have a worthless expired contract. So basically what it means, let's say again, company X is trading at $10 today, and in a month you again assume it's gonna be above 15, so you buy over $15 contract. You don't have to buy 15, you can buy basically $12 exercise price if they offer it. Sometimes with less volatile stocks, you won't get that. So you get the exercise price of 15, and on the day you have multiple options, right? So either the company or the stock like expires less than $15. So your bullish contract, which is your call option, this is basically worthless. The reason is you had an exercise price of 15, so unless it passes that, you're not able to even exercise it. And if it's less than that, it's obviously worthless, so you don't even have the option to exercise. So it expires worthless, and you basically are left with the premium that you paid for it, which is now gone. So one thing good with options, or a couple things that are good with options. First of all, uh, it's a cheaper way of basically speculating or thinking if you are very speculating if a stock will go down or up. And also it's because one contract equals to 100 shares, basically there's a leverage built into this from the get-go. So like as people are like trading with margin, they use somebody else's money, but when you basically trade these options or buy and exercise them, if your call is right, you get to make a lot of money from this. And because of the amount of shares it holds a single contract, there is inherent volatility as well. Um, so I might be going a bit random about this, but uh, after I make the video, if you guys have questions or if you guys want me to make this again, I will do it again. Since it's my first time doing it, and as I also learned very randomly, like I've been learning here and there as I needed more information, so I was just going back, learning. I can also share a couple YouTube channels that I used as my original starting point for so you guys can actually have a more direct approach. So there are obviously different types of options. The most basic ones are the call versus put options. So for call options, you're basically bullish about the company. So for put options, you're basically bearish about the company. Okay. Um, so if you think the company is gonna go up, so you're basically buying a call option. If you think the company is gonna go down, you are buying a put option. Okay. So for example, as I said, I usually trade the QQQ. So this is an index of top 100 companies in the US stock market by market cap. And it's very geared more so towards technology, some cyclicals and stuff, but due to nature of the index, it has a bit of that volatility into the index. And also wisdom, even if it's more volatile than like S&P index, which has the top 500 companies in the market, it gives you that um, unseen random, it actually protects you from these random moves of a single company. Let's say Tesla is in there. So let's say something happens to Tesla and they go down by 20% in a day, which you don't expect, which nobody expects. So this protects, the index protects you from that kind of thing. And if you do active trading, whether daily, weekly, whatever, you're gonna get into these troubles, right? One day, one of the companies you're trading is gonna have some unexpected news that will basically make your trade obsolete, and you might be losing a lot of money, especially with trading on a small account. And if you want to grow fast, you're probably risking a big chunk of your money, and one single trade can completely clean that. So that's why a lot of people, what I've learned, they like to trade with these indexes because it's more predictable what's going to happen to them, and they usually move with the market. So if you guess that right, then that's good. And another reason I personally like QQQ is it's heavily tech driven, and that's something I understand more than like a Dow Jones index where there are a lot of cyclicals, healthcare, that's stuff that I don't understand. So I get a feel for it. So I want to use that as an advantage for myself. Um, so I, on a daily basis, if I'm day trading, I would be like looking up the like major news that might be impacting QQQ. So over time, you get very proficient what kind of things can actually impact. And among mostly the things that happen to the index usually happens in the news usually happen in the beginning of the day. Like for example, today I was sharing you guys the some economic reports that came out of US, like job claims, like Fed um, meeting notes, which basically tells you they're gonna raise interest rate or no. So these are very important for like a index or company that's highly growth driven because interest rate has a direct impact to these companies. So it's gonna drive the price in that direction as well, which is something good because right now there's a fear of inflation, and every time there's a new mention or there's a new news about it, it directly impacts that. And I'm trying to trade that mostly. Although I try to look at the charts and do a few small like basic stuff, which I'm going to show you later. But mostly I am trading the market like sentiment uh, versus like what I see on the chart, which is basically a secondary thing. So right now, my technical analysis is basically very rudimentary. So I don't want to just look into the chart and say, okay, this stock is going to go up or down. But rather, I use the momentum in the market to say, okay, this um, index or stock will go up or down. And I'm going to use the options to trade for that. So in terms of the like how to explain it in a chart. So let's start with the call option. Okay. So basically, every time you buy an option, you pay a premium for it. You buy, pay premium, which sometimes they call it credit. So this is good for you. Sorry, if you pay premium, you do debit. Screw this. So how do I go back? So if you pay a premium, you basically deduct money from your account. If you sell an option, you basically receive premium. And you can use both in your advantage. Okay, so usually if you want to make money in this market, um, a lot of people like to sell options, especially the experienced ones, because they try to look at the market and see, or the stock, and see where it's going, and they're gonna try to predict what's happening to them, and they're gonna write options according to that. So if they're bullish about the company, they're just gonna write call options about for the company because they know that they expect, at least they don't know, they expect that the company is gonna go down, so they're gonna write a call option, which is basically selling a call option. And when they sell a call option, the purchaser has a right to buy 100 shares from you at a certain price if the price goes up. But because as a seller you are bearish, uh, you get to make money if the stock price goes down. So if you look in terms of how you make money from this, so obviously when you pay a premium, the moment you pay premium, you start at a negative. So let's say you just paid $10 to buy this call contract. So you're gonna start from -10, okay? And then you have your exercise price. So let's take the same X company. So you're gonna do $15 exercise price, okay? Uh, so for you to make money, obviously, right after the moment it hits 15, so like even if it's above 1 cent or like 15 and above, you have the right to exercise. But usually you don't want to exercise just for the sake of it. You want to make money out of it. So because you paid a premium of $10, so you only break even when the stock price goes up enough. So this is your break even point. So break even point. So you basically make money. So $15 minus, you did pay $10 for the whole contract. For a single share, you paid 1 cent, sorry, 10 cents. So your break even will be $15 plus 10 cents. So right after that, anything above 15.1, you are making profit in this region. So this region is your profit. Okay, so this is for a call option when you buy a call option. So obviously, when you make money, somebody's losing money, right? So the seller of that call option, if you exercise, so the stock price is at $20 when you exercise, basically that person has to give you the basically uh, the shares at $15. So $15, sorry, let's just go above a bit. So $15 multiplied by 100 shares in the contract, so it's $1,500. Okay, and right now the stock market is at 20, so you can go back to the market and sell it at 2K, so $20 multiplied by 100, and then here you go, you get a profit of $500 minus the $10 premium, 490 bucks. Okay, so here is what I like about options. So I was talking about leverage, right? So let's say on the day you uh, bought the contract, the company was trading at, let's just for the simplicity of it, let's say it was trading at $15. Let's use, so it was trading at $15. So you could have bought 100 shares then. So you would have paid $1,500 to own the shares. When it reaches $20, you would go back and sell for $500 profit. Okay. This is all good. The only problem is the initial capital that you have to pay, which is $1,500. And obviously, I gave a hypothetical numbers. Usually, the premium will be much higher. Let's say 50, like $100 or whatever. It's always going to be much cheaper, much cheaper than what you would pay for getting the stocks outright. So that's why there is that leverage for you. You can pay less to make the same amount of profit. So you would make $500 here, you would make $500 here, but you have less the capital you put up front. So basically your ROI is much higher too. So this is what I like about options. So it gives you that flexibility to uh, invest with smaller amount of money, and you can just basically go nuts with it. That's with the call options. So what we also have the put options. So these days I'm trading the call or put options. But I'm gonna get to spreads as well, which is just uh, basically maybe next level of it. Um, so put options. So same logic. When you buy a put option, again, uh, at, at the expiry, given your exercise price, you get to exercise your option if it reaches your exercise price. So in a put option, you are bearish about the company. So in this case, let's say the same company is trading at now $15, and but right now you're bearish that the company is going to go to $10. So, okay, so you buy a contract with $15 strike price. So that's going to be here, $15. Again, you are going to be paying some premium for it. Okay. So when you buy a put option, you basically are betting against the company, and so your basically profit would be anything less than, sorry, anything less than $15. So this would be your profit area, and if the stock price goes like towards zero, your gold. And in a put option, you always have so in a put option, you have the maximum profit because the company can only go to zero, right? So and there is that maximum uh, gain that you can get. So if the company is at 15 and goes to zero, so $15 multiplied by 500, so you make $1,500. But usually that's not the case. Let's hope that the company goes down to 10. So at the expiry or before the expiry, so there are two types of options that's traded in the market. So in US, there is American options, which gives you the option or the privilege to exercise your contract before on or before the expiry. But there's also European contract, which we don't usually deal with in North America. It only gives you that option on the expiry. So you only have that choice upon expiry and not before. So that's a big difference, but that's about it. So usually in this market, we just trade the American options. So upon expiry, you had a strike price of 15, the current price is at 10. So 15 minus by subtracted by 10 is $5. And you have basically, you can exercise them for 100 shares. So you make $500 profit minus your premium, whatever you paid for it. So, so in a put option, your losses also will be minimized because your option can only expire without happening much, and what you're going to be losing is the premium you pay for buying that option. Hopefully, so far it makes some sense. I know I am not the best explaining this as I'm also learning. So what I'm going to explain you guys next is spreads. Right now, what you can see that so let's go up. My chart is messed up here. Let's let's try again. Let's try again so you have a clear start. So let's say you want to sell a call option, okay? So in general, what happens with a call option, if you're a buyer of it, your profit is unlimited, potentially unlimited, because the stock price can go to whatever. So in that case, you are gonna be losing potentially a lot of money if you sell that call option, because someone will call back and say, hey, give me my stock at whatever price you bought, and then you're gonna lose a lot of money because the stock price just out of blue skyrocketed like to the moon, right? So in that case, you're gonna lose a lot of money. So there are ways even in the options to mitigate your losses. So one way to do that is to buy spreads. So basically, I'm going to talk about credit spreads, but basically same thing happens to debit spreads. But in credit spread, you are whatever you're selling, you're basically betting against what you're selling. So if you're selling a call option, you're basically betting that the company will go down. If you're selling a put option, you're basically betting the company will go up. So in a spread, you are basically limiting your uh, downside as well as the upside potential. So here is how it's gonna work. So instead of just buying a call option or just selling a call option, what we're gonna do is we're gonna buy. So we're gonna buy and sell options. So you have to buy and sell the same underlying stock with the same expiry. Okay, same expiry, but with different exercise prices. So if you want to do a credit spread for a call option, a call credit spread, they call it, you're basically going to sell. So let's say the X company is at $15 today. So you're going to basically sell a $20 call option. But on the other side, you're going to go back to the market and you're going to buy a $21 call option with the same expiry for the same underlying company X. So what it does is basically, in this case, you're basically gonna get, so the premium will be, so you're gonna get, let's say $1 for this, and then you're gonna pay 50 cents for that. So you're gonna get $1 for selling this contract. Then you're gonna pay 50 cents to buy that same contract with a different exercise price. So in return you get 5 cents, 50 cents per share. So it's gonna be, for one contract, it's gonna be $50. So you are basically getting a credit of $50 for doing the call credit spread. So what happens is, in this case, because you're getting basically money for this, so you are basically bidding against the X company. So at the end of the expiry, you want to make sure the company trades below $20. In that case, you're going to keep your full premium that you received from call credit spread. Okay. And that's amazing. But let's say the company actually does fantastic, unlike you predicted, and then it goes above $20. And at this point, you're at expiry, you're losing money. But one thing you did before was you also bought a $21 call option. So your downside is limited between these two exercise prices, which is $21 minus 20, so $1. So the maximum you will lose from this trade is $100. So in this case, to earn $50, you are okay losing $50. So it's basically what I would call is 50%, in this case 50% return, because you're basically putting $100 and you're making to make $50, which is 50% return. Obviously, the actual premium will be much lower. I'm just giving an example. And also the premium will get affected by how close your exercise prices are to the actual price at the time you're buying those stock price. So let's just give an example. So this is company X. So now they're trading at $15 and you want to buy a call option. So if your premium for $17 exercise price versus $20 exercise price, your premium for 17 will be much bigger than your premium for 20 because the company is less likely to get to 20 by the exercise price than 17. So hence the premium is higher for the one that's closer to your closer to $17. What you can also do is you can actually choose exercise price in the money. So in the money, basically, if for a call option in the money is basically going to be anything that's less than the current price. So this is in the money. So this is in the money. 15 is at the money, so ATM. And anything after 15 is out of the money. So for both put and call options, in the money options will always be more expensive because it's already in the money. So in the money basically means if it expires tomorrow and it's like your exercise price is somewhere here, you can exercise that contract. So that's why you are going to pay higher premium to own that contract. Kind of makes sense, right? So that's one of the ways the premium gets affected. So options are a mathematical model. Believe it or not, we actually spent 3 weeks to prove this model, what that's called Black-Scholes model. And 99% of it I also forgot, which is not relevant for most of the traders anyways. But basically, this model has a few assumptions about the market that we don't really have to worry about. But one thing that we want to know is the premium has intrinsic value. plus the extrinsic value. So this is how your premium gets calculated. So intrinsic value and the extrinsic value. So what affects intrinsic value is basically everything that reflects the company and how well they're doing, how close you are, whether you are in the money or out of the money. So that's gonna impact this. Extrinsic values are like things like implied volatility, implied volatility, and the time to expiration. And the reason is one of the variables in the options model, one of few variables actually, is if there's a thing called theta, and this theta is basically time driven. So less time to expiry, so the premium of your contract goes down faster and faster. So every day your theta will eat into your premium. If you bought a premium, your premium will go down every day because of the extrinsic value that's tied to your time. Okay, so usually your theta will be very small. If you buy a long contract, let's say 1 year expiry, your theta will be very low. So you don't really care about theta or like even implied volatility. So if you buy a 1 year contract, your extrinsic value will be extremely low. Okay, but if you buy contracts like I do 1 week or even less, sometimes 1 day, the contract will basically premium will be driven by implied volatility and time to expiry, which is very short. So implied volatility will be the big driver. So let's say you're buying contracts, whether put options or call options. You want to make sure the implied volatility is low. How low? A lot of people is trying to aim for 30% or less. So basically what implied volatility, so they call it IV. I'm pretty sure you've heard this a lot in other places. It even applies to Bitcoin and other assets. So basically every implied volatility basically tells you for every 1% change, how it will affect basically your premium. So let's say you have a $10 kind of stock, and when you bought the stock, implied volatility is like going through the roof, like let's say right now 100%. So that's the max. So $1 change in the stock price, so let's say it goes to 11. So your premium value will also get affected by this 100%. So if your premium was, I'm giving just a out of the blue number, if your premium was $1, so $1 move in the stock price will result in 100% premium. If it's in the direction here you are betting, it's going to go up by that value, so it's going to be 2x. So 2, or if it's in the opposite direction, then it's going to go down to 50 cents. So when you buy, that's why you don't want to like own or buy contract that has a high volatility. This usually happens around stocks that has high volume or around earnings date. For example, if you go into these days, AMC is going crazy again. So implied volatility will be going through the roof. So let's say I bought a contract last week, my premiums would be going through the roof, right? So I would be making like, I would be printing tendies right now. So these are the things that you need to look into. I know it's a lot to dig into and just absorb. Keep in mind, I was exposed to this at school a bit, so I had that a bit of knowledge from there. If it's new for you, I'm gonna send you guys like one channel who's doing a very good job to explain things, and that basically can set up your core, and then if you want to build on that, you can just go deeper. I'm just gonna send you a couple channels for that for you guys to learn, and I'm gonna make a separate video to show or on the laptop how I am trading these options or spreads. I think before I end, one more thing I want to tell about spreads is in spreads, usually it's safer, obviously, trade unless your spreads are large. So if your spread is like, the more spread you have in between, the more collateral you have to put. So if your spread is $10, 10 by 100 is gonna be $1,000 for each contract, right? So if your spread is $1, your collateral will be $100 only. So that also impacts, but at least your downside is limited by what you put as a collateral. So that's one good thing. And another good thing is, let's say you're not day trading, but in a general frame, you know where the stock is going to go in a weekly basis. So you do some technical analysis, or you look at the fundamentals, and you know that this company is just supposed to go down, it's just beaten down now. So you can like do like credit call spreads, or in this case, credit put spreads because you're bullish on the company, and let the company do its own thing as long as it doesn't touch your exercise prices that you defined. Okay. So this is a good thing about that, because it just sets you free. You don't have to worry about it. You can just let the theta eat into the premium people paid. It's going to lower it, so you're going to make money just by time passing. If the stock goes sideways or goes against the direction that you basically sold the contract for. So that's a good thing about the spreads. Safer if you know a few companies or stocks that you are very confident of, you know how exactly it's going to move. It's very good. I've been very successful with it. I think I traded for a month with it, and 3 out of 4 weeks was profitable. Another week was not, but that was basically me doing silly technical mistakes. So basically, what I was supposed to buy, I sold. What I was supposed to sell, I bought. So I made some like uh, stupid mistakes like that, and I lost that money on that week. But even that, I was able to defend it, sell it for a minimal loss, and things like that. I hope this helps, and I'm gonna show you guys more on what I do to trade for around these options.